This page defines some of the common income tax terms. Taxable income is money or equivalent received in exchange for your work minus expenses incurred, and also profits from your investments or business. Deductions are the expenses allowed by IRS that you incurred in earning your income. Your income is reduced by the amount of deduction before it is taxed. Your tax savings through deductions is equal to the amount of deduction multiplied by marginal tax rate. The deduction of $4,000 equals $4,000 multiplied by 25% tax rate, which is a tax savings of $1,000. Marginal tax rate usually refers to the highest tax rate bracket that applies to your income. For example, you are single and your job income is $80,000. The $80,000 level falls in the 25% tax bracket. So your marginal tax rate is 25%. Exemptions, like deductions, reduce the amount of income on which you will be taxed. Personal and dependent exemptions are available for taxpayers and qualifying family members. Refundable tax credits. These tax credits are usually a form of subsidy given by the tax system to taxpayer based on things like lower income, number of children, home ownership, etc. Tax credits directly reduce the amount of tax owed. A credit of $100 equals tax savings of $100. If credit is more than tax owed, then difference is refunded to taxpayer. For example, the refundable credit of $6,000 can reduce a tax of $4,000 to zero with a $2,000 refund. Non-refundable tax credits. If this credit is more than tax owed, then difference is not refunded. For example, a credit of $6,000 reduces a tax of $4,000 to zero, but does not generate a refund amount. This page is simply a list of the main deductions, exemptions, and tax credits allowed by the IRS. Press the pause key to view for longer time. Shown here are the tax brackets for the tax year starting in January 2015. On the left, we see the different tax rates that are applied to the bracketed part of a taxpayer's income. For example, the married filing separately status taxpayer pays 15% tax on the part of his income that falls between $9,226 to $37,450 and 28% tax on any income within the $75,601 to $115,225 range. A taxpayer may have any of the four filing status, and so we have four sets of tax brackets. The four filing statuses are married filing separately, single filer, head of household, and married filing jointly. The brackets are displayed in order of higher to lower tax applied for same amount of income. This page explains tax brackets and tax rates. In this example, the taxpayer is single, with a taxable income of $120,000. We see in pink the tax rates applied by IRS. Below that in violet are the tax brackets for a taxpayer with single filing status. Below that in light violet is the amount of income between each tax bracket. The tax rates are applied to the part of income that falls between the tax brackets. For example, he pays a 15% tax on his income within $9,225 and $37,450. Next in dark green shows our taxpayer's taxable income of $120,000. His income amount in the 28% bracket is $120,000 minus $90,751 or equal to $29,250. In the blue area, we see that tax is calculated by multiplying the taxpayer's income within each bracket by its tax rate. The tax in first 10%, 15%, and 25% brackets equals $18,481. Add to this his tax in the 28% bracket or $8,190. This makes his final income tax equals $26,671. In the brown area we see that, in addition to the income tax, the taxpayer also pays towards Social Security and Medicare. The state tax portion was withheld by the employer from his pay and sent to State Revenue Department. This example is presented to highlight the effect of multiple sources of income and the different tax rates they may attract. John Smith here receives $60,000 taxable income from his primary job, $35,750 from second job after hours, $15,000 rental income from his second house, and $2,000 in bank interest on his savings. As we have seen in previous screens, different tax rates apply to the different tax brackets. Although we have shown a particular order of adding up the different incomes, it is only the total amount that matters. The order in which the different forms of incomes are stacked is only to illustrate the probable tax rate you will pay on any additional form of income in this example. On his primary job income of $60,000, John's income is split into three parts, on which he pays 10%, 15%, and 25% tax. On his second job of $30,000, John pays mostly 25% tax and then 28% on the top $5,000. The rental income portion falls in the 28% income tax bracket and is taxed at 28%. Similarly, the top $2,000 portion, which is bank interest, is taxed at 28%. As shown earlier, the different tax bracket calculations are added together to arrive at your total tax on taxable income. This is also to illustrate that you could pay higher tax rates on additional income above your primary job. You can use your W-4 forms to contribute towards this tax. You complete a tax form W-4 for employer's payroll department when you start any new job. The W-4 form is used by payroll to withhold the proper amount of federal income tax from your paycheck, which means receiving a very small refund or tax payment notice when you file your tax return. In W-4 you provide your correct name, social security number, and address. You indicate your marital status, dependents, and other sources of income, and eligible allowances. In W-4 you can authorize additional tax to be withheld as tax payment towards, say, other income like bank interest. For ongoing employees, one should submit the revised W-4 tax form if the original needs to be altered due to a change in personal or financial situation. Your employer withholds tax from your pay and forwards the tax withheld to IRS and any applicable state tax to state revenue. Employer also withholds and forwards amounts for Social Security and Medicare. In January every year, you will receive a consolidated wages and tax statement W-2 for the year, which information you use to lodge your tax return. You should lodge your tax return by April 15th. The federal tax withheld in your W-2 statement will be adjusted against the income tax calculated in tax return. In this view you will see the various key components that are included in your tax process. Starting on the top right is income like wages or pension, which is taxed at source by the employer or payer, by way of federal tax withheld from your wages. Next is income like bank interest or rental income, where tax is not withheld at source by the payer. So you are expected to pay tax on this income, by way of 4 estimated tax payments to the IRS over the year. Next is income from capital gains, or mostly income from the sale of investment assets you own, like property or shares. This income is not taxed at source. You pay a flat 15% tax on the sale of long-term assets. The other tax component are deductions, exemptions, tax brackets and tax rates, federal tax withholding and payments, and tax credits that could be refundable or non-refundable. And lastly is your final tax assessment for the year.